So for those that have been following us, we like to look at different data points, and the consumer confidence one is always one that can vary wildly. And we like to show all of it. And there's each one has their place, and we don't put more weight in one versus another. It's just what is the general trend. And when you look at University of Michigan, when you look at the Gallup poll, when you look at consumer confidence in the Consumer Confidence Board, so there's three key pieces that are showing how are people feeling, how are people looking at the market, because people are going to look at something, they may say one thing, but they're going to spend differently until they don't. And the problem on figuring out until they don't is credit, because people will always want to maintain their current lifestyle. It's very hard for people to accept the fact that they have to lower their home price or they can't afford the meat that they were eating before, or because it's depressing. It's you don't want to feel like you're taking a step back. So people will do whatever it takes to try to maintain. They'll cut out some of the ancillaries, but they really the core they want to try to hold, and that's where credit comes in. And that's why we're going to talk so much about credit cards, and what the Fed is doing, because that's really going to adjust how people are going to use credit. Because as rates go up, so will the cost of credit. And that's, again, something the key pieces. Now, there are no Russian or Ukrainian cities to talk about. So this, I won't trip up multiple times this time. So it'll be a little bit cleaner, that I can promise. So as we kick it off here, you can see the Gallups Economic Confidence Index. You're seeing that we're right back to where we were during the great financial crisis. We are below where we were for COVID. And a lot of reasons for that is because going into COVID, there was the assumption that there was going to be something done, whether by the Fed, the federal government, or both, so that you had a quick snap back up. But now things are getting a bit worse. So the Economic Confidence Index now lower than 2020's COVID recession, though not yet down to the great financial crisis levels, but approaching, which is a bigger problem because it's 2022 and we have midterm elections, which is why there's been more talk about bringing crude down, bringing gasoline prices down, trying to insulate some of the things that really hit people hard. Diesel is something that is a much bigger problem, but you don't see that up front. You see that as it compounds on how you're spending, what you're seeing, but it's gasoline that you're paying for directly, and that's why there's so much talk about it constantly in the different markets. Now, one of the some of the key things is the real GDP. So you have GDP, which is gross domestic product, and then gross domestic income is the GDI, is looking what is happening within the country. So what is happening between the GDI versus the GDP side, and that's where you can see that there is some benefit to the U.S. given some of the shifts in terms of GDI versus GDP. And that's what we've been talking about with some of the regional data, where things were performing fairly well, weakening, not saying that they weren't weakening, but they weren't negative yet. Now, something that we'll talk about in this segment and the next segment is some of this data has gone negative now. So we do expect to see some of that additional pressure coming to the downside. But again, you're seeing some of that benefit in terms of the discrepancy is almost 1.5%. So that's something that is a benefit for those looking within the U.S. versus abroad. But again, there's some pressure that we expect to continue to come through. And you can see that they're typically fairly tied together, but you had that big divergence. And so as we got into Q3 of 2020, that has continued because you did have a lot of federal stimulus. And that federal stimulus, a lot of that was stayed in the U.S. and didn't look at or didn't influence GDP to the same way. Because GDP is when you're looking at exports, imports. If anything, when you think about the purchasing that has happened, that has increased the imports, which is why when you look at some of the biggest drawdowns on the GDP side, it was the global trade balance, the U.S. trade balance. So then when you start looking at growth, income, and as someone who is actually deemed a millennial based on just how the years break down, I can attest to the frustrations that we have seen, or at least I have felt, when it comes to growth and economic output, because this is something where economic output is typically going to hit you directly in terms of the home that you can purchase, where you can purchase it, the price that you can do it at, what your salary looks like, how far your salary can go. And I thought this did a really good job of just showing on the inflation-adjusted gross domestic product side, per person grew during each generation's first 15 years in the workforce, starting at age 18. So here, when you look at the GI, those that were born between 01 and 24, that as they came back from World War II, there was a huge boom in terms of from the urban, creating that suburban outlet. I don't know for anybody that likes watching The Food That Built America. I actually enjoy the show, and you can see that there is a big increase in some of those, the convenience side, and that created a huge amount of opportunity. You had the birth of everything from McDonald's down to Pizza Hut and in between. You had a lot of these shifts, and you had a big increase in just affordability. You had prices coming down. You had fast, convenient food. And then when you start thinking about that silent generation, the GI, the silent, and then you obviously have the boomers that came into the booming side in terms of just everything was going gangbusters, and then things slowed down. And then you look at Gen X, and now you look at millennials at this point. And that's why when you look at the millennial side, it's easy, and trust me, I hate on my own generation enough, but that's why you see a lot of those that are disenfranchised, that are, well, how do I increase my position? Because typically you want to do better than your parents. And not to say that you want to rub it in their face, but you want to show that, look, this is what you helped me pay for. I want to achieve what you've achieved and then some. And that's getting harder and harder, which is creating some of that disenfranchised nature, which again is that social mobility, the ability to get a new job, the ability to climb the corporate ladder. And if you think back to when people were working at the same job at GE, Lockheed, all of these, they would be there for 45 years. They would start as analysts and work their way up. And by the time they were 28, they had P&L responsibility, and they felt like this is their company. They were building something. And now you've had a lot of that be lost, which again just speaks to some of the problems that we've seen, and I guess the socialist tendencies that have emerged. So here, when you look at, okay, well, let's take what is happening right now, and now let's look at what is happening into the different areas. So the expected weaker data well into 2023, and this is just looking at some of the leading indicators. When you look at new orders, when you look at where some of these problems are going, the ISM New Orders Index is one of those leading indicators. But the problem is when you look at the change in U.S. 10-year yield going up, that's when you typically see new orders fall. You typically see that pressure. And again, that's something that is continuing to be the case. And it's only going to get worse when you think about the 10-year going up, when you look at the Fed's June maturities, and now that we're in June 1st, you have the quantitative tightening. So four Treasury securities held by the Fed are maturing in June, totaling $48.25 billion, leaving $18.25 billion over the $30 billion runoff cap to be reinvested. So when you think about the what does that mean? So they capped the $30 billion on the runoff at $30 billion for the first 3 months. That then gets extended to about $95 billion on a combined level when versus the after 3 months. So when you look at some of the pieces, the first roll off, if you will, is going to be fairly soft. So when QT officially starts on Wednesday, which is obviously today, first Treasury won't run off until $15 billion mature June 15th. Fed capping monthly runoff at $47.5 billion, which is 30 billion treasuries, 17.5 billion of mortgage-backed securities. So again, there will be some reinvestment. Then they double to combine to 95 billion versus the peak of 50 billion a month in the Fed of 27 of quantitative tightening. So again, you're seeing some of the different pieces to this. So again, it's going to be slow and gradual, but you've had a net buyer that is still going to be a small net buyer, but then as that roll-off adjusts, as you can see from the maturity dates, that's going to mean that you're going to have someone that's going to become a net seller. Now, it won't be a huge hit in June. It'll be a smaller hit in July, but when they extend after that 3-month kind of period of people adjusting, that's when you're going to start to see a much bigger hit as we go into the end of Q3, but really into Q4, that you're going to see the Fed really starting to sell down and accelerating, which is going to put more pressure on rates as we get into the end of the year, or as everybody a favorite term, the second half, which everyone likes to talk about. Now, it's not surprising that FOMC members have noted that there are upside risks to core PCE. That's where you can say, duh. There's only so much you could say. But uncertainty has eased back a bit, and the uncertainty just because you had uncertainty come back, but this is old. Now you've had uncertainty increase, given that you've had crude prices go up again. You have gasoline hitting a new all-time high. Diesel has flatlined a bit, but again, there's a lot of those flexible inflation components that are going back up as you have core inflation continuing to accelerate, and now you have flexible inflation also accelerating for May, and it's not stopping in June. So again, that's where we see some of that uncertainty coming through. Now, some of the things that they've been talking about wanting to do is really protect the MOVE index. And here you can see that they brought some of it under control, but it has bounced back up. It'll continue to go up today because yields have gone back up. The biggest issue is just how high it is and how long it stayed there. And if you look at the end of 19, where we started to get a bit more bearish, you can see that the MOVE index had gone up, was choppy, came down. Obviously, the explosion during COVID. But look at how it's had a gradual move up. And now it's sticking here. This is what they want to bring under control, which just is, again, more support for rate increases and maintaining their quantitative tightening cycle to try to bring this under control. Because the bond volatility, rate volatility is damaging not only for the consumer, but also the corporations that want to borrow, want to lend, and the banks in terms of, well, which rate do I use? Well, if rates are so volatile, I have to charge a bit more to help insulate myself. So now when we look at some of the recent data, you can see that mortgage applications were down more than expected at 2.3%. They're expected to be about 1.7% down. So again, more deceleration. Global manufacturing was expected to be at, U.S. manufacturing was expected to be at 57.5, came in at 57. Construction spending, missed estimates, came in at 0.2 instead of 0.5. ISM manufacturing, in terms of some of the breakdowns, ISM manufacturing was expected at 54.5, came in at 56.1. ISM prices paid was expected at 81, came in at 82.2. So again, that's where you have that inflationary driver accelerating more than expected. It's still down from the month before, but it's re-accelerating, and we see that increasing again in June, which just means that we're on the wrong track if you're looking at prices paid as some of those leading indicators. New orders did have a nice pop. That is a leading indicator, which is a positive, while employment started to slow, with job openings remaining fairly stable, down but above estimates, and we'll talk about that in a minute. So now when you look at the U.S. manufacturing PMI, production new orders increased at slower rates. Cost inflation fastest since November 2021. Business confidence drops to the lowest since October of 2020. So that's when you start looking at U.S. ISM manufacturing prices paid and CPI inflation. That's where, if you look at where manufacturing prices paid are, led with 3 months, you're seeing a lot of staying power, which is what we've been talking about, of the rate of change of inflation slowing, but still remaining elevated and leading into that stagflation. We do think that the rate of change is still going to be positive. We're still going to see upward momentum, but just slowing and giving way to some of that stagflationary pressure. Then when you start looking at the manufacturing index was at the 56.1. But then when you start looking at some of the different pieces, you had inventories rose, production rose, new orders rose. But then when you start looking at deliveries fell, customer inventories fell, which again should keep some of those new orders, which is why new orders went up as inventories kind of normalized. Prices paid still elevated, and that's again some of the key pieces to it. Now, new export orders rose, but slightly, so it's still slightly expansionary. Again, some of that kind of where There's some growth. It's not rapid growth. It's not crazy growth, but there's still something there. But imports fell, and that's to the lowest since May of 2020. And for those that have been following us, we've been talking about imports are that leading indicator, which is why we do see some of that pressure coming up. Which is when you start looking at U.S. disposable income, chained 2012 dollars. You can see it's slowing again. U.S. personal savings as a percent of disposable income, again, down to 2008 lows and decelerating faster as people use savings and credit to try to maintain lifestyle, which is something that will be a bigger problem. So some of the things that we want to talk about, one issue with transition from goods to service spending, which is that white, is that the savings rate, which is the orange, has collapsed and real disposable personal income has been contracting. Consumers had a lot of firepower to buy goods, but they're losing that firepower for services. So we do expect to see that alligator mouth collapse a bit, but it's going to be more about the goods accelerating faster to the downside. We don't see services slowing. We just don't see the pace increasing as much. It'll increase, but again, it's the rate of change where the goods slowing down will accelerate and the services, increasing just at a slower rate. And that'll, again, bring that back down together just because of the pressure that the U.S. consumer is under, which again is being reflected in the economic sentiment index. So here you can see is at a low since going back to 2021. And then when you look at new jobs, fairly stable, but weakening a bit. Personal finances softening, but again, still fairly stable. U.S. economy weakening, but the view of major purchases and new homes still remains at record lows. And here was some interesting piece where the U.S. high earners who report living paycheck to paycheck. So when you start looking at these individuals in terms of millennials versus boomers, I thought this was an interesting piece. Now, boomers typically have more assets under their name, just given they've been around longer, they've been able to acquire more assets. So it provided some ancillary income and ancillary wealth that has been able to insulate them, but there's still a decent amount living paycheck to paycheck. And those people should be retiring soon. So now you're starting to see it's like, well, how can they retire if they're living so close paycheck to paycheck? And then on the millennial side, you can see that, continue to live well above their means with 63% in that 100,000 to 150,000 K salaries are living paycheck to paycheck. It doesn't mean that they're uncomfortable and that they can't comfortably meet their paychecks, their costs and their monthly living costs. But again, it just shows there isn't a lot of savings happening and it's depleting faster. And as inflation goes up, yes, these people can still spend, maintaining their lifestyle should be fairly simple, but their discretionary spending above is going to whittle down. And that's where we've seen an increase in the amount of people using revolving credit card debt. Obviously, the average is higher as people who are on the poorer side of that scale continues to be under pressure. So they're going to use revolving credit more, but you can see that on the 250,000 plus, almost 65% of people, 63% or so, or among all consumers, 61.3% report living paycheck to paycheck, a 9 percentage point increase from a year earlier, and about 63% are able to pay off their credit cards every month. But you're seeing a decent amount that are starting to increase that, and they're just either have perpetual credit card debt that they just pay the minimum or they try to whittle it down. But as inflation goes up and the need to use credit cards go up, but that as the Fed rate goes up, their cost is going to go up. So yes, the ARP of borrowing on a credit card is insanely high. Anywhere from 14 to 18% for people with good credit scores, but that is only going to go up, which is going to shrink because now you're going to have to pay more interest expense. You're going to be incentivized to bring down your credit card debt, which again is going to eat into your spending overall. And then the growth tack warns of a sharp slowdown in the U.S. economy, as you can look at just where the different prices are on commodities, on inflation, on a lot of these different pieces. And again, that comes back to even the highest earners, the top 5% of the U.S., is living paycheck to paycheck. And even though they won't get the same type of hit, it's still going to pull back on some of that spending, which is why you're seeing consumer loans, all commercial banks, the consumer loans is not only above where we were pre-COVID, but it's back to that insanely sharp increase, which again is becoming the underlying problem, which is why real disposable personal income, as Wells Fargo has forecasted, continues to be at well below that trend. So the trend going up of debt continues, but the trend of personal income remains fairly flat to negative. As you can see, that government transfer payments continues to slow. As you have programs expiring, government assistance continues to fade as transfer payments made up only 17.8% of U.S. personal income in April, lowest since the pandemic began, which will continue to shrink as we go through the rest of the year. And then this is just looking at savings boom. The personal savings rate has fallen to 4.4%, which is back to financial crisis era levels. Now, when you look at headline inflation, factoring all of this together, you have the headline number that has come down, still increasing, but at a slower rate, but core accelerated. And that's the biggest problem, is the core piece continues to accelerate, which is what we've been calling for, where flexible was going to come down, but core, the piece that really hits the spending at the most basic level in terms of what you can afford, that is going back up, which again is going to hit living wages in general. And then price measures, this chart shows the options-based probability that the PC inflation will be above 2.5% over the next 12 months, which is obviously very high. And as you can see, it's near perfect or near 100%, which I think is not a hard thing to say given just where prices are at this point in time. You know, personal consumption still staying at these levels. A lot of that is coming from credit and savings, and that's where, again, people are going to try everything they can to hold on to what they've gotten comfortable and used to. And that is a hard thing to break. And that's why when it breaks ugly. And just calling that and timing that is the hardest piece. So when you look at U.S. consumer spending, again, you're seeing services coming up, but the durable and non-durable goods still staying fairly strong. We expect that to roll over. Services, we think, is going to hold this current rate of change, increase steadily, a steady increase, not a huge turn up, but there's going to be more of a turn down on that durable side, which is why when you start looking at the Consumer Confidence Board, the expectation was for 103.6, actually slightly better at 106.4, still coming down, but consumer expectations are much worse and holding at those levels. So consumer confidence right now still weakening, but better than we were in COVID. But then when you look at expectations, that has continued to get worse, and that's going to slow things down, because if you expect things to get worse, you'll start to hoard, and that creates some of those additional slowdowns. Falling optimism among small businesses will also lead to a slowdown in hiring, a slowdown in what they're starting to see. And those individuals who own the businesses or executives in the small businesses, they're seeing the pain, and they typically start to adjust as well, just showing some of that additional pressure. U.S. Michigan Personal Finance Index, the people are looking at their finances, expecting things to get worse. Business conditions in 1 year, lowest it's been since essentially 2011, and below pre-COVID levels. Again, more pressure on the business front, as U.S. PCE inflation was expected at 6.2%, came in at 6.3%. And then the Dallas Fed trimmed mean PCE, again, all of them just showing new highs. It's just that slowing. It's the rate of change is slowing, flatlining down slightly, but we do expect to see that acceleration in May and then another one in June until we get to July, which is where we expect that stagflation to really pick up. And then this is just looking at the data as well, looking at core price index, again, at how elevated we are, and we're still above. And in order to see where we've been like this before, you have to go back to the early 80s. Which is why when you start looking at job openings, slowing down just a touch. Indeed is kind of that leading indicator for where we are. The JOLTS data it beat estimates, but is still slowing. And again, there's a bit more people coming back, as we showed with the hiring at the small businesses. That is slowing slightly. You're starting to see some of that pullback, and we expect that to accelerate a bit. And what this is just looking at job openings to the number of unemployed, 1.92 in April, down slightly from March, and we expect that to slow down just as more people come back into the market, more people come back actively looking for work, that's going to, again, increase the underlying numerator. And then some of those jobs, as we talked about, from small businesses, bigger corporations, also slow on the denominator side, again, bringing some of this back into a little bit of a normalcy, if you will. And then, as we showed earlier, the U.S. trade in goods balance, sharp bounce in April goods deficit to 105.9 billion versus the estimate of a decline of a negative 114.9. And it's just because exports increased 3%, imports declined 5%, and we do expect that to accelerate again as China has slowed, and we won't have as many imports in the near term. So that's what we have for you on this segment. In the next segment, we're going to talk about the housing data and some of the consumer data again, and look at how those are intertwined and why we see that leading to something a bit bigger on the U.S. recession in terms of bringing us and pulling us down on the activity front.